Hello, this is Cryptolyze. I hope you are well. This Saturday, 16 December 2023. We meet again today for our weekly. We will come back to what happened this week and especially talk about the figures and Powell's intervention on the macroeconomy, the impact that it will have on BTC and cryptos in general, and take stock of the closing of this year. We are not going to talk about the closing itself, but we are going to start preparing for this closing of the year by having a vision. A little monthly of what is happening to be able to look ahead to this end of the year, to see how we can have an acceleration or deceleration at the end of the year, and above all, to talk about ETFs, BTC, because we're going to come back to the dates, because I think it's really important to understand what can or especially what can't happen, and that starts right away. If you want to train and really enjoy bull running, it's simple. There is perfect, complete, free training available. It's through an educational journey that teaches you everything about blockchain, crypto, investment, technical analysis, and trading. All this for free in comments and descriptions. You have exercises, multiple choice questions, modules, videos, guides, everything to support you in your progress. So obviously we're going to start with the macro part because I think it's really very important. We had a lot of things happen. And in particular, a speech from the Fed by our friend Jerome Powell, which was quite strong, quite powerful, because he generally said that discussions of reducing rates were currently being carried out during Fed meetings. And that's really very, very important news. And we can see very clearly the market's reaction to this, where we have an acceleration, particularly at the level of the S&P 500, where we really see this enormous candle that we were able to have. We are in the process of retitling, precisely, the highest that we reached in December and January 2020. Finally, December 2021 and January 2022 levels, which, as a result, we did not think we would see them again immediately, or at least immediately. And it will be interesting to already, one, have a reflection on what is happening, why it reacts like that, and secondly, is it technically consistent with what we could have in terms of schematics? And you will see that there is a little bit of everything that is coming into order. There is a little bit of everything that is coming into alignment, and I will explain my vision to you. Once again, this remains only one of my visions. This is the one in which I have the greatest percentage of bias. That is to say that I think that it is the one which will have the greatest probability of coming true. But once again, it remains probabilities, and we readjust according to the different figures. Already, the fact that we have the Fed talking about lowering rates is normal, okay? This is something that is rather classic. I already explained it to you 4 months ago when we started to set up with a sheet which said, but we are not going to reduce rates right away. Maybe even at the end of the year, we will increase rates. I told you that for sure. He can't say it right now that they're going to stay on it. That's normal. And on that, I also explained to you that it was certainly going to change at the beginning of next year or even the end of this year. Well, exactly what happened, Dad. So maybe in terms of tone, it's a little bit different. But what's interesting is that he tried to be between the two. Yes, we started talking about rates, but he also clarified that they had the means to ensure that inflation really reaches these two, which is the target he wants. And what is interesting to see is that in this notion of possible elements, there are several things. One, we must understand that the reaction here of the price, the upward acceleration of the price, is linked to something very important. It is linked to the fact that the market is anticipating a rate cut of 150 points next year, which is huge. Okay, so that means lowering the rates of 1.5, here we are at 5.5, that means we would go down from 1.5 over a year. While historically we have more of a vision of the Fed, which would be a reduction of half as much. Understand that this is already an overvaluation, and we must understand that this is also what is projecting the S&P 500. To know that we also have good news. We have, for example, this week, over the last 10 days, retail sales which are on the rise, so that shows an economy which is resilient. We have a PMI service which is also on the rise, therefore a resilient economy. Has inflation which is falling rather positively, yes, but which is perhaps not falling as quickly as expected, which keeps the same growth rate. Next to it, we have oil which is also falling with levels which are very low. When we look at oil, we see that we have arrived at levels which are systematically bought back, so we know that we are more or less at the bottom of the range. The probability of breaking this level is still relatively low. For me, the level of 60 will be strongly defended. Therefore, this implies that we risk going to re-accelerate at a given moment in oil prices in the coming quarters, so that potentially means an increase in the price of energy, and therefore inflation, which may potentially not come down in its objectives of 2. And what is interesting is that the market considers that there will be a real drop in rates because we will really arrive in this typology of having inflation, which will be at the decline, which will arrive in the 2. There are 2 possibilities anyway for the Fed to act. Either we have inflation that is controlled at 2, or we have an economy that is doing badly. So it is generally the 2 which are the elements which will trigger the fall in rates. Either an economy that is doing badly, well, clearly that is not the case, or inflation that is reaching 0. Will we be able to bring this inflation to 2 and maintain it at 2? Will we be able to do it quickly enough compared to what is being priced by the market? Personally, I tend to tell you that I don't think so. And even the fact that the economy is doing well means that there is no point in lowering rates. I mean, we can lower rates slightly, but we don't need to find rates that are at 2, which are at 3. For me, when we look a little bit at what is happening in terms of 10-year American government bonds, and well, still that, we will come back to the left side afterwards. But when I see this, I say to myself, what is the probability of returning below the 3.5 or 3? What is the probability of passing this bar? Namely that we have an economy that is solid and that the economy is changing, absorbing. Here, rate management, there are many that are refinanced, but we even have the real estate sector which is starting to recover. So at a given moment, what will push the Fed to reduce its rates when we have not yet reached inflation in the 2? Well, not much. Not much. And this is precisely where I am saying to myself that we may be overreacting on the market. And precisely, technically, do we have elements that allow us to understand it? I want to say yes to you if we have a slightly more Eliottian vision in which we also have a vision of the market on dollar. From the hunt for liquidity in which we actually had this peak, and when we look at the bearish breakout, we really had it in 5 stages on this. These are not impulse waves because we have the 4, which took the top of one, but that prevents it from remaining Eliottian waves in 5 stages, in which we have here a consolidation which is done in 3 stages. These 3 times have 2 possibilities. Either we end with 618, something that we are really not far from. It should be noted that it corresponds. At the top, either we finish on 1 OK at 5,250, which has the probability that we go as far as 1 I think is quite low, unless we have very, very positive news with a technological breakthrough driven by artificial intelligence, and therefore behind the text, the Nasdaq, which is struggling to rise. Currently, I think we are still relatively far away, and that is not the scenario that I personally have in mind. For me, I am more concerned with having a distribution that is in the process of being made and having a hunt for liquidity and having behind an A, a B, and a large C, which will be divided into 5, which could simply go and do a retest because we could very well be on a flat, we could be on an extended flat. Well, there are plenty of ways to do an A, B, a C. We don't have to go and break 3,600. We can very well go and retest the 3,900, the 4,000. It doesn't matter much. It will really depend on this A to see the extension ratio that we will have at that time. But for me, I am in this image because we have an overrepresentation, an overvaluation of stocks. Currently compared to this year that we had, to the previous year, and to the news that we are currently having. For me, the narrative of the Fed's reaction is still overreacted in my opinion, and it would be normal for me to have Q-own Q2 2024. Quite quickly, a breathing of the market which risks being relatively violent and which could even be relatively express. For what? Because even just technically, when was the last time we actually saw candles like that, too? Impulsive and also consequent and also consecutive. 1, 2, 3, 4, 5, 6, 7, 7, with candles that have body, which really have body, which have relatively few wicks. 7. Actually, 7 in a row, there aren't many. I came up, I came up, I came up, I came up again. Ah, yes, but it's really small. I went back up, I went back up. There we begin to see. Okay, it's 2009, and even then I consider that it's not sufficiently impulsive, and it's the same. I went back to telling myself that overall it was really very, very rare enough to ask myself the question of a market anomaly and how far we could continue to go up like that. Everyone before having a market breathing which could be relatively violent mainly because of the rates, because we are still in this inversion of curve. Here we have the representation of the rates. I talk to you about them regularly. 2 years, 10 years, and 30 years, which are represented. We have the blue one, which is the 10 years, which actually gives us medium point. We have the 30 years higher, and then lower we have the 2 years. Generally, we always have a rate which for the 2 years is always at the bottom, except that here we see it clearly. We have a gap which is between the two, which in fact represents the risk rates that it can have, so the more we are sure short term. The less risk we have, and well, there we see that it's the opposite. So for me, there is really a subject that is structural at the level of the American economy, which is in the process of shifting, and that could precisely be a trigger. Are we going to have a breakup? Are we going to have something that will be catastrophic? I do not think so. I just think we're going to have a retracement that's going to be healthy. You just have to anticipate it and not rush off and say that we're going to have a break and that it's going to be to the moon on the S&P 500. I don't see a narrative that would allow us to have it. The fact of having an economy which is serene and having inflation which has not yet returned here in the vicinity of 2, that means that we will have rates which will remain relatively high perhaps for some time to come. For longer than expected, and we will be able to have a process of reducing rates which will be very controlled and perhaps much slower reciprocally. That means that we will have an acceleration in rates which was very rapid and very brutal, very strong on really very shortly, and therefore a drop in rates afterwards which could be really very slow the more resilient the economy is. And on the other hand, this would not be the formula for a soft landing, but would not be the one that is currently being priced by the market. You have in the description and comments the possibility of downloading my strategy guide on investment and trading in cryptocurrency, in which there are 30 pages to know everything about how to proceed, how to benefit from this bull run. And in addition, in description and comment, you also have the possibility of having access to our newsletter, which is available and which will be available every month. The links are in comments and descriptions. And so, what's happening to BTC in all this? Because it still changes a lot of things. Yes and no. That means that even if we have some market breathing, that doesn't mean that currently we would have, I'm going to go back to my monthly vision, in which we would have something rather classic, all in all. That means that we would have QON QT2 Q23 2024, in which we would have breathing space from the American market, therefore pressure. A little stronger on the entire market, therefore a lateralization of BTC, or even perhaps a little breathing of BTC, which would also correspond to the general idea of having a buy the rumor, sell the news, of which we spoke several times. On that note, I just want to come back to this idea. The fact that we have ArcShare, which must have its final deadline on January 10th, okay? And so, obviously we have to validate everyone on January 10th, because otherwise it is not legal, or at all. Case it is not appropriate, yes, except that we can very well say refuse that of ARC, then behind ask ARC to redeposit with the new conventions to then accept the whole thing, okay? And go get the month of March, or even potentially refuse everything and then file again and so on. Well, I think there is a fairly low probability, but the most important probability for me would not be validation at the beginning of January, but perhaps still work. In March, we can clearly see that there are a set of meetings that are held. These are meetings that are held with BlackRock, which are held with Fidelity. We don't have a meeting with ARK, we don't have a redeposit with ARK, and this is where perhaps we have something at play. And we have Gary Gensler's position on crypto, saying that no, he will not have a specific crypto securities law. In any case, he does not want it. We know that. We suspect it. So it is. Either that he will clearly work on the securities part, and that alongside he explained that the court decision which was given in relation to Grayscale changed his vision and the vision of the SEC by report to ETFs. Well, clearly he told us that it was validated and that it was going to be validated. The question of when will be present. And I think that, in any case, we will know at some point on a sell the news. What is the other thing that points me towards this? Well, that's what ARK is doing. For me, ARK is positioning itself on, in effect, a sell the news. We see that they have started to validate their profit-taking. That doesn't mean we're going to break and retest the lowest ones. No, we are very far from that. But that means that there will be a form of breathing space and that they are in the process of implementing their profit-taking policy, which is a profit-taking that is rather logical and normal. And for me, we are in this process, and the two are in the process of coinciding. So is it me who is reinforcing my bias through a form of coincidence reinforcement? It is certainly the case. But I am aware of it, and in any case, I am prepared for that do not arrive. I'm not someone who waits. I'm someone who anticipates and works through each scenario in advance. And I hope to pass that on to you as we go along. So whether it retraces or it doesn't retrace, whether it lands or not, the important thing is to be prepared and not want a single scenario. Personally, I tend to see these elements as something classic. There is nothing new compared to what happened on traditional. There is nothing new about something that is happening at the BTC level. And for me, precisely, given that there is nothing new, why hope for something new? Different while it has the smell, it resembles what we already know. For me, I am more inclined to tell you that the probability is to have a retracement upstream of the halving during the halving, and a little bit afterwards before setting off again on the bull run at the end of 2024, and which will be a real, truly impulsive bull run. There we have a preseason which is very pleasant. We are taking advantage of it greatly, and we prepare for the rest. For what? Because also technically, if we look a little bit at Ishimoku in monthly, it's very interesting to see that there we are on a crucial level. This is the level of rejection we are at. We are between Kinjun and Tenkan, and we are at the limit. Here, we are really in a zone of confluence, of rejection. Clearly, if we have to play it, we will play it there. This means that if people really want to trace, take their profit, it will be done here. We can have an extension with a strand behind it that is refinished. But the monthly closing, whether it is this month or whether it is the month of January, it doesn't matter. We can have this month closing here, the month of January in which we begin. We have a big candle there, which is swallowed. And we fence underneath, it's not a problem, okay? We are on a monthly long-term vision. And when I look at that, I say to myself, yes, indeed, we are in a big zone of resistance. Is there still a confluence in relation to that? Well, I want to tell you, yes, we are going to go weekly. What do we see? We see that, in fact, we are in a zone here in which we have been systematically sold once, twice, 3 times, 4 times, 5 times, small extension taking liquidity. Rejection. So this is an area in which we will be sold and in which we will have a profit taking, which will be in these parts, which is rather normal. And that's why we see this candle here, the first really red candle we had. It's the entry into this range. We entered this range, we typed the top, now we are rejected on it. And even in the short term, we see that we still had a very strong downward impulse, something we hadn't had for a very long time. When we go back to this bullish acceleration, we have not had a breakout as we have experienced here at the start of the week. And that's why we have an indication from the market of the positioning that is being carried out. And that's why we have to be very careful. I think that having a bullish reaction and a retest here is normal, but not necessarily a bearish reaction. Once again, the bearish reaction is not strong enough, so that means that potentially we will retest at the top or even look for liquidity. We have a form of uncertainty which is being created. But it's not really an uncertainty, it's more even a compression of liquidity to prepare for the next movement, which is bullish with the hunt for liquidity that we could have here or here to go and rework the longs, okay? We know that we have 2 gap CMEs which are present. I am not going to go over what I present to you in the daily newspaper. We follow developments. We understand how the market is carried out on a daily basis. The weekly aims to show you that, in fact, we are in an area in which we have different market behavior, because we are in a different period. Because we are arriving in December in which we generally have profit-taking, we have a year, 2023, which was very strong. We have an American economy which is showing signs of resilience with inflation, which continues to fall, but which is not accelerating. So potentially we will have at some point rates which will remain very high for be able to maintain the decline in inflation for even longer to reach this target of 2. And then will we be able to reduce rates without inflation starting again? This is the question to which we do not yet have an answer, and which we will absolutely have to keep in mind. Because I think that there, we could have something very interesting to play in terms of BTC with the arrival of ETFs. ETFs in all cases will allow exposure to certain institutions and certain groups to BTC, and therefore the construction of specialized products in which we will have an additional valuation of risk assets. Especially if we find ourselves in a market where we has inflation that we cannot bring down to 2, and therefore we are obliged to keep rates relatively high, we will be obliged to look for performance not on stocks, but on others. Asset typologies. As long as we have a real rate, I remind you what it is the Fed's remuneration rates, subtracted from the inflation rates. If we are positive, we are on positive real rates, and at that moment, there is no interest in seeking risk. If we are on 0 or even negative rates, there is an interest in having risk, and the goal is to get there. It is to potentially arrive at an equilibrium. We are getting closer to 0. where the funds will have to seek risk to seek return because, as a reminder, they are paid for performance. They are paid to hold funds from certain people, institutions, individuals to make them grow and obtain a return. If they cannot have a return, they have less funds and therefore less results and so on. Hence the interest in building these products and seeking risk only if we arrive at real rates which are close to zero. It's up to you to think about the situations where we can achieve this, and I think that if you can project yourself into this, you will see that the scenarios that I describe are consistent with this reflection. I hope you like this video. If so, don't forget to leave me a like, a comment, and even share because it supports the channel, and above all, it makes me very happy. I wish you a very good Saturday. Otherwise, we'll see you tomorrow for the Sunday video, which will be, like all Sunday videos, very special.